In looking at question D, Kipkorir Kipyegon is an alternative investment manager for Stanbib Asset Managers, which deals with commodities trading. He is currently investigating trading opportunities in the copper market. The spot price is 316 and the 3-month forward contract price is 313. He is contemplating implementing a reverse cash and carry arbitrage to profit from the difference between the spot and the forward prices. Currently, Kipyegon can borrow or lend cash at the rate of 5% and the lease rate for copper is 6%. The borrowing, lending and lease rates are all continuously compounded interest rates there. Required, number 1, describe the 2 components of synthetic commodity position in this arbitrage. Now, in trying to answer that, we need to understand commodities. Now, in commodities, we have what we call, this is prices, this is time or maturity, let me put it like that, maturity. We have the spot prices being at that level, and the forward prices being either at that level or being at that level like that. In terms of trying to identify the synthetic commodity position in this arbitrage, or the 2 components of the synthetic commodity position, the first synthetic commodity position that appears is when the forward price is greater than the spot price there. When the forward price is greater than the spot price here, that is what we are saying is a contango. That is what you're saying is a contango. The second case is where the forward price is less than the spot price, and we are saying that is a backwardation there. And so those are the 2 components of synthetic commodity position that we need to understand like that. So we can put it all together and say that this is D. Number 1, backwardation. We can say that this is a scenario where the forward price is less than the spot price, implying that the term structure is downward sloping. Number 2 is contango. Contango, when you say it's just the reverse position of this, we say that this is a scenario where the forward price is greater than the spot price, implying that the term structure is upward sloping. It's upward sloping. Now that is part 1 there. Part 2 is asking compute Kipyegon's profit on a reverse cash and carry arbitrage in the copper market. Now, reverse cash and carry arbitrage uses the following formula. So this is part 2, this is D part 2, like that. The formula that is used within the commodities market is that the forward price is given as the spot price, transcendental factor or the exponential power plus rather you less convenience yield component like that, and then we are saying we multiply that by time factor right now. So we say where SO spot price, RF risk free rate, C, we are saying that C, cut. This is the convenience yield, and then if we have any component of storage cost, we can be able to slot it in there, or we add in the component of storage cost there. So what we can do, we can draw probably a small line over there like that for the purposes of trying to distinguish. Now, what we are saying is that if it is continuously compounded, this is the transcendental factor, or what you're saying, E, we can be able to put there, is exponential. Exponential is what is used there. Now, if it is not, if the forward price is not continuously compounded, what happens is that now we will have the component of F being equal to the spot into 1 plus R and then times T, like that. Notice the difference between that. That's why I have specifically put as a division right over there like that. So this is spot price. This is 1 plus the rate of return, and that is time T. In this case, we've been told that it is continuously compounded, so we will deal with this formula right above over there. So putting it all together, we can be able just to try and identify the spot price. In this case, the spot price, so F, we can say the spot price is how much? In this case, I can see the spot price is 316. We said we are using this one over here, multiplied by the exponential. Please note the exponential from your calculator. We can see that the exponential value is 2.71828. How do we get that? You need to see where the E component is on your calculator. Like this one of mine over here, I can be able to see. This is Casio SVPAM or FX85 MS. You can be able to see it. It's somewhere right over there. So you press Shift, then E power X, and then you press 1. You'll be able to get the transcendental value or the continuously compounded component of 2.71828. So multiplied by 2.71828 and like that, and then you raise it to power RF. In this case, our risk-free rate is how much? Risk-free rate of borrowing, lending and borrowing. You can see you can lend and borrow. You can lend and borrow cash at 5%. That is the risk-free rate. So power 5% minus, is there any component of the lease rate, the convenience yield? The lease rate is 6%, so minus 6%, like that. So how much? Do we have any time frame there? I can see the we are being told that the spot price is 316. Is contemplating implementing a reverse cash and carry a bridge to profit from the difference between the spot and forward prices here. I don't seem to see any period right over there. Is it part 2 is asking on the copper market. So the time frame 3 months. Yes, I can see 3-month forward contract there. So it has to be 3/12. Remember, this is raised to power that component over there. So let's see how much it gives us over there. That we raise power 0.05 minus 0.06 multiplied 0.01, sorry, pardon me, 0.01 multiplied by brackets 3 by 12. Close the bracket there. We have 1.002 there. So we have 316 multiplied by times 316.79. I don't think that is the case. I don't think that is the correct value. Let me just do it slowly, please. So it's 0.05 minus 0.06 equals multiplied by 3 by 12. You get that. and then 2.71828 per 0.9975. So we're saying times 0.9975 and multiplied by 316. We have 315.21. 21 like that. That is it. So please first of all get the transcendental value like that, and then you raise it to power this component right over just by this formula right over there. Now to answer the question, we're being asked compute the profit on reverse cash and carry arbitrage in the copper market. So we found the forward price over there, and the profit that is going to be earned is just going to be the difference between the two prices right over there. Which two prices are we talking about? We're talking about this 315.21, the forward price. So profit loss is given as 315.21 there, minus how much was the price that was being used, the spot price, rather the forward contract price was 313 minus 313, and you are saying here is how much? Minus 313, we're saying is 2.21. 2.21. That is the profit that is going to be earned on reverse cash and carry arbitrage. This brings us to the end of question 1. We hope that you will be able to join us in question 2 or even the subsequent questions. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.